my very good friends. I hope you're all doing really well out there. I'm Rocky Outcrop. This is a Bitcoin technical analysis video. Up behind me right now, I have the 24-hour Coinbase chart, and I've got some show notes on there to explain what we'll be doing in this episode. Just want to say before we start, please hit that subscribe button and that like button. I would really, really appreciate it. The eagle-eyed amongst you will notice I've got a couple of tabs open at the top, so we'll be looking at a couple of things in a moment. And yeah, right, okay, so let's just dive on into it. It's June the 6th. It's the 6th of the 6th, and BTC is at 9666. Ooh! Well, actually, it's not at 9666 at the minute, which is disappointing, but it was just a moment ago when I was writing out these show notes. Okay, so basically what we've got here, and I say basically because rather than the word essentially, because just it is actually quite a basic setup here that we're looking at, and it's all quite similar to yesterday, and we're waiting on it playing out. So you can go ahead and watch yesterday's video if you want some more details about all of that as well. But we'll be looking at it in today's video too, and like I always say, these videos are relevant for more than just one day at a time. And I thought I'd have a bit of a discussion because there's room in this episode, given that the price action hasn't actually dramatically changed since yesterday. There's a lot of room in this episode for some discussion about different things. So I thought I'd have it start off by saying, ever notice that other folk out there are saying what I'm saying about a day or two after I've said it? Yes, well, I have. I thought that's kind of funny, and I thought it was a laugh. And I would just kind of refer specifically to, for instance, Carl over here, whose chat is more or less more or less the same as what I was saying, days ago. He's and it's all, well, like, as he's it's all just like it's all just old. This video came out 41 minutes ago or 45 minutes ago or something like that. And shut up. Sorry, Carl. I actually think Carl's a great guy. I've got a lot of respect for the guy. I really do. But and I think that what he's done on YouTube is phenomenal. Look at that, 106,000 subscribers. That's phenomenal. 657 likes and a video that came out just 45 minutes ago. But it says nothing in it that we haven't already covered in extreme detail over quite a while now. Actually, a number of days really. We've been looking at this at least, and it's all just old news, and I thought, oh, well, I'll watch this and see if he says anything interesting in it. And to be quite frank with you, he just says a whole bunch of old news, and then he goes on to talk about people on Twitter, and I'm just basically not interested in the Twitter chat at all myself, although I'm on Twitter. So if you want to follow me, shush, Carl, if you want to follow me, then I am Rocky underscore Outcrop on Twitter. Carl meme. Carl. The reason I'm saying Carl, by the way, Carl. Jeez, remember that from The Walking Dead. Okay, not everybody watches The Walking Dead, but if you do, you might have had a laugh there with me with this. Anyway, maybe one day in the future there'll come a time when a video I put out gets 600 and something likes, at the start of just, momentarily after writing one. And, this here chat, let's have Carl explain it for me. He can do this now. And this is how I feel. This is how I feel about getting 20 likes, okay? 20 likes on a video. Thank you so much for like 20 likes. It's insane to me that I get 20 likes. Yeah, so much engagement. 20 likes, it's amazing. If I get something like that, it's just so much engagement, and I love it. And then, like, I'm not going to shill the bloody bell button. Hit the bell if you want to hit the bell, but if you don't hit the bell, then go to hell. I don't know, that rhymes, but it's not what I think. Anyway, yeah, so that was a laugh. Carl! Let's look a bit at the lower time frames together, okay, for a wee while, and also a little reminder that there's a lot of perceptual, subjective nuance in the world. Now, for instance, in Carl's video, he says that nobody can disagree. Nobody at all will disagree at all. Nobody in the world. I think we all agree. 100% of us, definitely 100%, all agree without question that we're in a monthly uptrend. It's what he says. If I just go to take all the drawings off the chart here, so you don't see all my show notes, actually leave them on and say and show you, like, look at this is the sort of dense information that we put out in videos, as opposed to the really sort of light videos that Carl puts out there. And he does great. Maybe I overcomplicate things, and if I overcomplicate things, then, well, you know, you're not going to enjoy the second half of this video where things get a little bit even more complicated. But yeah, cool. Anyway, nobody can disagree that we're in a monthly uptrend. Nobody can. Let's stick it on logarithmic so it looks more like that or whatever. Nobody can disagree that we're in a monthly uptrend. Nobody can. Nobody can disagree. Nobody can disagree about it. Everybody, 100% of the world agrees, because what we have here is a high, then a low, then a lower high, and you know, since December 17, so 2 years and 6 months ago, we've been in yeah, anyway, so nobody can disagree that we're in a monthly uptrend at all. 100% of the world agrees, and yeah. Carl also talks in his video today about how John McAfee says that I've got a cup of tea here. I'm going to drink it during this episode as well, because, like I say, there's time for it in this one. John McAfee said 2 years ago that Bitcoin was going to go to $1 million, and now McAfee says that it's only going to go to, that's not, that anybody who thinks it's going to $1 million is an idiot or something like that. And I don't know, Carl feels betrayed by McAfee or something, which is hilarious. You know, I've had a few tweets back and forth with McAfee and stuff like that, talking about, you know, orgies with clergy members and stuff like that, or whatever, you know, that type of chat, or, you know, talking about guns or something. And the guy just likes a bit of chat, you know. He's just a meme. He's just a walking, talking meme, and that, who cares? Anyway, this monthly trend that we're in, the drawings are all going to appear back on the chart. You can see that there's, if I were to draw that line in there, it would come up like that. So we can maybe look at this on the 24-hour time frame and drag it up a bit here or something, and get where's my purple downward sloping line? Is it just not showing? Anyway, look, basically, essentially, we're not in a monthly uptrend. We've been in a monthly downtrend since December 2017. It's quite clear, and I don't know, and it's been that way for now a couple of years. So anyway, nobody can disagree, but I choose to differ. Now, there are significant things to be said about it. Of course, we can monthly uptrend. I'm not even going to talk about it anymore. Smash that like button, by the way. Smash it up. Let's get 3.4 thousand likes on this video. Can you imagine? People don't want to hit like on videos that have got nuanced, difficult, sort of comprehensive, holistic, technical analysis in them. Instead, they want to have it sort of spoon-fed BB stuff or whatever. Anyway, and that's what you get. You know, that's how you get the likes. Do I go for those likes? No, I don't. Right. So let's look. So we've looked at the monthly time frame enough. Have we really looked at it enough? Over here, maybe I can fit it on without all the noise. You know, yeah, I can. Just so we can have a wee look at this and say that there isn't anybody out there who can possibly disagree that we're in a monthly uptrend at all. You know, you might be wondering why I'm saying that so often in that manner. You know, here we are. This it's significant what we're in. You know, this significant monthly uptrend. Or do you want to position it like this instead? Do you want to position it like that and what? Just kind of try and get as many bodies as possible. Then you got this body here and this body here, and then you've got this body here, which makes it look like we've broken above it. But I can just as easily do that, and then just as easily do that. And look, you know, that's on. We can put the line right on the body there, right on this body here. Is it? We're just, you know, I can force the issue if you want, just to make it so look like that's touching it right there on that edge. And here we are. You know. Anyway, I'm just doing all that for a laugh. Just for a laugh. Like I say, timing this video for this because yesterday's video covers all of the actual technicals for us. Let's go down to the small time frame and have a quick reminder about what we've been talking about recently. And that is that there's the potential here for this head and shoulders. Now, this is not an ideal setup. It's not exactly like a head and shoulders. There's plenty of things that are wrong about it, such as the volume isn't quite there. But I can do it sort of Carl style, you know, for instance, and just you know, remove the volume right? There we go. And then it looks a wee bit more like one because because you don't have that down there anymore. So you don't have that confirmation bias or anything on the go, which is good. When you don't have it because of something else. I'm just kidding. That's me speaking backwards, by the way. Of course, this isn't confirmation bias. This is us saying that this is us. This introduces a little bit more prudence into our trading than having it than not having it on there. But plenty of people don't look at that, and that's fine. Another thing I wanted to talk about as well in today's episode was how plenty of people, they've got this, they conflate a couple of things together in their head when they're talking about their analysis, and they say like things like having less indicators is better, and it often is. Essentially, some people just trade purely based on basically absolutely nothing. They don't even have, they don't have moving averages or anything else like that, and they're disparaging of them. For instance, Daniel from Chart Champions, who is actually, he's one of these funny people who's a blend of complete asshole and really nice guy at the same time. You can watch his videos and you'll get this impression, like when he talked. I watched one of his videos there yesterday just for the crack. I always explain, by the way, I always tell people when I watched a video of somebody, I watched one yesterday just for the crack to see what he's saying. No, it was live. It came up on YouTube saying he's live, so I clicked it to see what the chat was, and he was talking away about how when he was in Cuba, some kids came up to him and asked him to play football, and he was almost like he was quite emotional talking about it, and saying that you don't get people being nice, and and his sort of way of learning Spanish was by going up and talking to people and communicating, and you get this impression that the guy's is probably a really nice guy, right? He probably is, but he's also like frustrated by bad technical analysis and idiots in the world and stuff like that. So if you see him talking on Twitter, and Twitter does bring out the worst in all of us, by the way, then he comes across like a complete a-hole. It's unbelievable. Anyway, he's one of the guys that trades without moving averages, disparages them because they're lagging, and doesn't use the volume either, and essentially just looks at the horizontals. And when you boil your trading down to just such a simple set of methodologies, that he calls them parallel channels, because you stick it because you do whatever, you do whatever you want, really. You can just get out the old parallel channel tool here. Where is she? Stella. um Yeah, I've got loads of esoterica in my videos today. Oh, look, we've got this channel here, blah, blah, blah. This will help us trade, for instance, stuff like that. Whatever it happens to be, that's maybe a bit high. I think Daniel wouldn't have it so high as that. I think he has his one maybe more like this, something like that. I don't know. And yeah, basically, if you can trade off the back of something which is something like this and be successful, then you're going to really do well. So I want to just throw out a message to people in the world that yes, more is often worse. It's often not as good. It's often not. If you use these things in order to do things like have confirmation bias, or indeed to do this ad hoc adjustments to your hypotheses, then you will find yourself, actually introducing more and more variables into your trading, which can lead you to go wrong. And simply just having a very direct approach to doing it is probably the best way to trade. Now, then you think to yourself, well, why, Rocky, do you talk about so many various different things on your videos? Well, actually, because we do it without the bias, without the confirmation bias or anything else, and we just take a holistic look. And my videos here are in order to help integrate with yours, in the most effective way possible, so that you can get a full picture of the market without actually having without any of that confirmation bias. I don't put it on you in the way that like basically every other YouTuber does. And instead, I also say I'm not a YouTube monogamist, which is why I'm happy to talk about the respect that I have for people like Daniel from Chart Champions, who is a really effective and good trader. The respect that I have for Carl, who's a really effective and good YouTuber, and the respect that I have for people like Eric Crown and Mitch Ray, who I think are actually genuinely really good traders that look beyond just that I've got the experience from looking at different angles at things to be able to kind of introduce more stuff without that confirmation bias necessarily, or so to speak. Anyway, there's various different things. I actually have a massive respect for absolutely everybody out there in the field, even Da Vinci J15, who uses Fibonacci retracements when he's drunk doing his videos. I'm being, I think the guy's great, right? But the fact of the matter is that he goes on pissed half the time. You might not notice, but it's kind of obvious to me. And he's like, "Yeah, we got a Fibonacci thing here, so I'm just going to like look at this Fibonacci thing," and he does that. And you're like, hold on a second, you just do that from right to left, you know, and you're just looking at this entirely the wrong way around. That's not how this works. That's not how that would work. That's wrong, you know. But you know, here's a guy that bought Bitcoin when it was worth pennies, and since then he's developed into a trader, and he uses his own techniques, right? You can do these things, although there's a textbook way of doing stuff. When the textbook way for Fibonacci, for instance, would say you only ever go left to right because, you know, whether that's an uptrend or a downtrend, you only ever go left to right, and that would be the Fibonacci retracement on. He's somehow found a way to be a successful trader doing things the wrong way round. And if you look at the way that they line up together, you know, they're similar enough position throughout the whole thing that it doesn't really matter. You know, it doesn't really matter if you're just kind of trying to like look for zones or whatever. So anyway, chucking all that out there. Now, back onto the lower time frames. What are we talking about here? Can't really even be bothered that much looking at them, to be honest with you, because you know, like all that information's out there in the world. And what will I talk about then? Actually, just like I'll just go over to the CME chart, remind everybody that there's a couple of gap fills to the downside and the upside. Actually, is what I'll do in this video. And for instance, down here at 8,950 or so, another one at 7,500 or so, and another one at 6,950 or so. Then I invite you to go ahead and watch Carl's video, and he'll explain to you all the stuff that you need to know about these things without mentioning that. And it ties together. I'll go back over here and I'll point to the Fibonacci stuff that we've got on the go here. There's two Fibonacci retracements here. This one drawn in left to right, of course, from from the sort of the swing low. It's not on this time frame. That's the hour. That's the hourly time frame. Let's go up to the 24-hour time frame. What have you done? What have you done? You've put noise on the chart again. Drawn in from this low here, whenever we kind of can see that the 10th of May was the start of a sort of uptrend currently. By the way, sorry for the light flicking around on my video. I can see that on the screen. It's kind of the contrast, the dynamic range going crazy, because I've got the sun shining in the window behind me, and I'm not, exactly going to do anything about it to change it. So yeah, drawn in from the lows here up to the highs here. It's positioned off to the right, so you can see the numbers a bit better. Positioned off to the right, I say. Look, there we go. It's positioned off to the right a bit better now. And you can see that we're below the 236 on this one. And if we had a head and shoulders breakout, it'd bring us down to the 618 on this. And then you'd be asking the secondary question following up with that. If you go through the 236 on this Fibonacci, which is from the march lows up to the most recent highs, body to body on that one, at 8,950. And again, that ties in the CMEs. It ties in with all the various horizontal levels. And then you have down here, I'll go through this in great detail, all the horizontal levels, a la Daniel's chart type trading, just where you purely look at horizontals and play support and resistance. Fair enough, absolutely fair enough. And here they are all on here. You can read that, or you can again watch yesterday's video where we go through them in detail, and the day before and the day before. They've not changed, and you can draw them out yourself on the charts. There's various different ones. Like here's my Bitcoin chart from BitMEX. All of these horizontal lines, bear in mind, were drawn on like months and months and months ago. Months ago. If you're a subscriber to the channel, you'll know that I've not touched this chart in freaking ages. Here's this chat as well. Did we come up here, break out of a symmetrical triangle, come back down? Are we retesting at the minute, finding support? There's a lot to be. What we're doing. I don't want to actually not have these things on here. Are we getting supported in around the 21 EMA? Blah 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 blah. All of that ties together. And on the sort of the smaller time perspective, if you go down to something like just say 6 hours, for instance, and you look at this and you say, well, could we potentially have some sort of head and shoulders? All ties together there. It's all done, right? It's all done. All is done. And let's go on to talking about what I wanted to talk about yesterday, or no, not yesterday, today. What I wanted to talk about today. But a reminder, here's the last paragraph. So anyway, we've also covered here, by the way, that the fact is there's a lot of perceptual sort of subjective nuance when it comes to charting. And of course, if you go on like Bitstamp, so it's got a whole load of history, you take off the drawings, you stick it on them monthly. You stick it, it's on log still. You can say, look, we're in a monthly uptrend. We're consolidating at the minute, so it's debatable and whatever else. But you can basically say that since Bitcoin came back out there and started trading in 2011, and then went towards the upside, that basically it's been an asset which has been a really good investment. So for all those guys that managed to get in, a la Da Vinci and Carl Moon himself and whatever else, when it was kind of cheaper than it is now, yeah, times are great. But I think that in terms of being an actual trader and literally not giving two flying potatoes, like I said in an episode recently, whether the price goes up or down, and you're actually just trading this, and you're not looking for a revolution tonight necessarily. And really, rather than changing the world overall, what you'd really just like is if police brutality kind of just stopped and that people were able to get along a little bit better. And you don't want your granny's money under her mattress to be worthless overnight necessarily, or for the world to be made redundant or any of that. You just, and you accept that there's corruption out there in the world anyway, no matter at what level you are in the world, and that that things like Britain, the United Kingdom had death counts in Kenya right up until 1985 and only apologized for them in 2014 or so. If you know about these things and you realize that no matter where you are in the world or how good you are in the world, and that America's been in a war with another country ever since the Second World War non-stop, or the First World War pretty much, but the Second World War, and is an imperialist country too, and everything else, you realize all of this stuff, like how they had to make a different version of Call of Duty to be released in Germany because the swastika's banned there, and stuff like that. All of this, you realize that that's the world that we live in. Then maybe you're not exactly waiting for Bitcoin to change things overnight, and instead you just want to trade it in the meantime, and make money. And in which case, that's what we're all about on this channel. So again, hit that subscribe button, hit that like and subscribe. I realize that today's video is massively different to every video I've ever put out, and I'm going to just continue that now when I go on to talk about look at the amount, again, by the way, just to reiterate, if you are looking for some serious technical analysis, here, bring this one over. This is a random one. May the 31st, possible gap, only fools rush in, avoid above 955, highs 9705, the DMI, the ADX pretty low, right for a move, blah, blah, blah. Here's one from the 28th of May. We're in a triangle. Triangles descending, blah, blah, blah. Looking at Ethereum prices for more confirmation, blah, blah, blah. Bring over another random thing here from the past, the May the 29th, tons of information. Here's one, June the 3rd, sorry, not yesterday's, but a few days ago. Tons of information there, tons and tons and tons. It's all still relevant. Go ahead and watch it if you want. This video here is just for the crack. I'm just having a crack with y'all. So if I could actually move the charts over to the right and get up the notes again, just so I can kind of, actually use the notes as we finish off today's episode. Zooming on in a bit so they're legible. And again, there's the white chat, the white writing there shows you all of the different levels. If we go up above 9850, then this area down below tells us what we're looking at. And then the downside targets are the first ones on the list because they're the more interesting ones currently. They're the more pertinent ones really for the technical analysis. So a reminder that there's this thing called the Dunning-Kruger effect, right? And this is kind of what I've been getting at. It's a bit of just for a laugh, right? Just for a laugh. Not disparaging, not casting shade on anybody, I'm not, because I genuinely have massive respect for all these people. Massive respect, and I don't think that they're so much experiencing this. This isn't what they're experiencing, and I'm not saying that, but it's just sometimes maybe it is better just to have things done simply, and just to put a drawing on the chart from that video. Where is it? Where is the drawing thing? The rectangle. So you do a rectangle like this. This is your knowledge, and this is what you believe. If I make videos where I just hinted that this is the maximum that you needed to know in the world, and this inner box is what we're covering in the videos, then I'd get more views and it would all be great and everybody would like it, and you'd still be more or less just as effective trading, to be honest with you. But the reality of it is that this is what I cover in my videos here, right? And I know fine well that the world out there is much more like something like this, right? Much more like that. It's impossible to put this in a video. Anyway, let's jump on over to something from Stanford, okay? Just to have a wee chat about this type of same sort of thing, and to remind people that what you to do when you're trading really is to kind of, I think the best way to think about things when you're trading is to look for when you're wrong, right? So I often talk about in these videos about perspective, confirmation back. No, what am I trying to get at here? I often talk about in these videos the that people, yeah, prediction, that was the P that threw me off. I said perspective instead of prediction. People like to think about trading as being a matter of predicting the future and having a crystal ball and all the rest of it. And sure, a lot of these videos come across like that. Somebody said in a comment recently on what was it, Tezos, I think maybe, or the Ethereum, I don't know, that they're amazed at the surprising accuracy or whatever, I don't know, something nice about the accuracy of the levels, you know, that we've come in, that we've predicted these levels, predicted, so to speak, right? And these levels. And that's not what trading is about at all, right? It's not. Trading is about, if there is one part of this massive box about what trading is about in reality, and I wanted to just discuss one little bit of this whole big box, this bit here would be risk management, right? This is it, risk management. And you know what? If you were to draw out a box in terms of the important aspects of all of this, then the risk management aspect would be like that. The risk management in terms of importance is like this, okay, in terms of the box, right? So you can cover quite a lot of what needs to be known about trading by looking at risk management. So it's like that, right? Risk management. And it's not, and the outside part that's left, that's the predictive part. That's the predictive part, okay? That's what's left. So so the way to think about things is actually to have a sort of idea of the null hypothesis or the false hypothesis. And the scientific method is a really interesting thing. And if you're interested in the history of science, then I highly recommend that you go and learn more about it. It's something that I found fascinating, especially like, for instance, when I was at university. And I remember learning all about Kant and the philosophical approach to the history of science and everything else, and just how everything is in terms of like the world has evolved. And part of the reason why I did that, by the way, was because I had an optional module choice when I was doing my master's about and Edinburgh University is one of the centres in the world historically for medicine, and there was a two-part course, and the first part of it was the history of science and the second part was the history of medicine. And I wanted to do that at Edinburgh University because where would be better in the world for it? Really, not very many places in the entire world are going to have the finger on the pulse quite so much about the history of medicine as Edinburgh University, which is genuinely amazing. For instance, the hypodermic needle, anesthetic, stuff like that, all invented just literally 500 meters up the road from where I am right now. So anyway, fantastic stuff. I really loved it. But the first half was about the history of science, and and I did a null. Oh, screw it! I'm 26 minutes in this. I don't care. I'm just going to keep going. If anybody's watching still, you can this is just me. This isn't technical analysis. This is an entertainment video. Again, though, if you've managed to stay through to the video for now, hit that subscribe button and that like button. Whatever. I do genuinely massively appreciate it, but I appreciate as well that when I used YouTube before, I never hit the like or subscribe button on hardly any videos because I thought it would populate my feed with a bunch of crap I'm not interested in, or I go onto YouTube and I specifically would look up the Bitcoin stuff or something like that, and then I'd want the feed to have other stuff in it, which is and I didn't do it. Now I realize that was actually wrong. That's not the way it works. You're better off hitting like and subscribe on everything that you genuinely like and subscribe, and then things get better. But I understand if people are hesitant to do that. Anyway, yeah, so that this is just me chatting. Anyway, what was I getting at there? So the false hypothesis. I definitely had another sentence in my head and I've missed it, but whatever. We're all good, aren't we? So so you're better off trading with this sort of the false hypothesis idea, right? No, yeah, and I did that with my exam because they got me to read that book by Kuhn. I read the whole thing and I had to do my coursework on it, and I was so disparaging. The fact is, I didn't get it, right? I didn't get it. I didn't understand it. And the coursework counted for 40% of the exam course. So, and the pass mark for the entire year was 60% is minimum for pass. That you had to get. I might have those numbers wrong. It might have been like 70% minimum for a pass, and the coursework was 30%. The point is, it became a binary situation because I actually submitted my coursework and got given 0 for it. 0. It was unheard of in the 0, like no percent. I did it on time and everything. 0, because the guy just absolutely straight up hated what I'd done. Fair enough, life's full of difficulties that you have to overcome like that. And rather than appeal it or whatever else, I don't know, as a young confident man, I guess, I decided that I would just kind of null hypothesize this thing altogether and go for it and say, well, either I deserve to pass this course or I don't. And right now it's pretty binary. I actually think I do deserve to pass the course, but the only way I'm going to pass is if I get 100% in the exam section, 100%. And given that I got 0 in the coursework, I thought, well, this is what life's all about, right? And this is partly how I've led my life. Okay, I know that this is living life on the edge, and it's not what anybody else would do. And I also am now aware that the video is at 29 minutes, and this is way longer. There's me talking about having space, and I've done fecal technical analysis. But hey, here we are. So I thought that, okay, this is a binary situation now. I have to get 100% in this course in order to pass, because I got 0% in my coursework, and the examiners and the lecturers and everything else, they basically had despised me. So either I'm going to have to completely capitulate their opinion about what I've learned in the course and everything in the exam, or I'm failing. Even if I get 99%, then I'm failing the course. It's like it's make or break. And yeah, I went into that. I was one of the only ones I studied for when I was at uni, and I went into that exam. And I really didn't know how it would go, but I'd actually tried. I'd tried in advance, and trying. Like, by the way, here's a great tip for you: try. If you try in life, things are better. And if you feel like you're already trying, then keep at it. There's perseverance is the second tip. But anyway, I went into that exam, and I was the first one to leave the exam hall. I'm not just blowing smoke out. This is just whatever. Maybe it sounds too much like I'm being big-headed here. Hit the thumbs down button if you think I'm an asshole. Got to get a bunch of that, I reckon, in this episode. Anyway, living life on the edge, just like that exam here with this episode. So anyway, I actually tried, and I went into the thing, and I was the first person to leave the exam hall. It was one of those exams where you just did it. It's just like, here it is. Unlike this episode, which has turned into 31 minutes. It was Dr. Johnson once said, that I'm sorry I didn't have time to write a short letter, that type of thing. I was able to go into that exam. It was a 3-hour long exam, I think, and I left after 2 hours. And I'd written out everything, just everything, and I kind of like put it at the end, like whatever. And now they're blind marked papers. That's the thing as well. So the examiner didn't know who it was that was doing it, although they might have been able to guess. They might have. There's a probability there that they could have been. There's maybe 100 people in the course. Maybe so there's at least a 1% chance that statistic, whatever, right? You work it out yourself. And but whatever. Maybe there wasn't quite 100. Maybe there was 80 people or something. I don't know. And yeah, so and then I passed the course anyway. Obviously, that's the end of the story there, and I got the 100% in the exam thing. And looking back, I should have appealed. I should have appealed the coursework. It's completely unfair to give anybody 0% on coursework, even if you're supposed to get marks, right, for things like spelling, and like, you wrote it in English, right? You wrote it in English, and it was about the topic, right? And you said, and it was, and the coursework, was like 5,000 word essay. You must have said something in there that would have got you at least 1%, but no, 0%. It was a massive fuck you to me from the lecturer. So anyway, yeah, I batted back a fuck you with the 100% exam mark at the end of it. Anyway, one of the things I learned on that, and I'm just going to straight up close the thing there. One of the things I learned on this course was about the scientific method, okay, and how he came about with it. And there's, in terms of, and I'm not going to go through this entire thing with you here, right? But in terms of trading, and my takeaway from that particular course that I would pass on, bearing in mind that I'm, only that in terms of the coursework and everything else, that I didn't do so great. If I just go find KHUN, is it KHUN or is it KUHN? KUHN? Yeah. So, like, bearing in mind that when it comes to the structure of scientific revolutions, 1962, I'm not your man to ask about questions about that one, or at least I wasn't before whenever I submitted that coursework anyway. But yeah, if you want to talk about how you would use any of the scientific method when it comes to trading, then the bit that I would recommend most is to kind of take away the popper. Where's the section here? Popper and falsificationism. Okay, and so I'll just read through this with you, shall I? And just so that you know, you can apply a lot of this to trading, in a sense that when you're trading, right, and you're looking for and this is what I'm talking about in terms of predictiveness. My God, tangent city here. If I go scientific method, obviously you can see I searched for a couple of things before doing this episode. I only spent 2 minutes, but if I go scientific method and go to the Wikipedia about this, then you can see that there's a certain approach to these things, right? And just in general, right, you've got the process, you've got the formula of a question, a hypothesis, then you've got, pardon me, prediction, and then testing. So don't get confused and conflate the different, pardon me again, completely different aspects of this, right? There's the predictive aspect in advance where you're talking about things and you're making predictions, and of course that's really crucial. And I'll always, have a predictive element in terms of the technical analysis that I do. And again, I apologize for this not being technical analysis at all, and me just deciding that even though it's 35 minutes into it, that I'm still going ahead and publishing this thing, whatever. Now there's a predictive element, and it comes in here as part of the scientific method between the hypothesis stage and the testing stage, So you would make a prediction in advance and try and test that. And, the actual, what you want to actually try and do is what Karl Popper here advised scientists to try and falsify hypotheses, i.e. to search and test for those experiments that seem most doubtful. Now that's obviously quite reductionist there, and then the final stage of it is analysis, right? Crazy, okay? So if you're to try and apply the scientific method to trading, then there's so much there which we don't need to look at. We don't need to look at hypothetical deductive. We don't need to talk about Descartes or any of that, okay? Or whatever for this sort of for the talking about hypodermic needles. We're going injecting straight into your veins here. The one thing that I would say that I would take away from this and apply to trading is this idea, right, where you've got and let's just read it. Another approach that took off from the difficulties with inductive inference was Karl Popper's critical rationalism, or falsificationism. Falsification is deductive and similar to HD, similar to this hypothetical deductive, in that it involves scientists deducing observational consequences from the hypothesis under test. For Popper, however, the important part was not whatever confirmation successful prediction offered to the hypotheses, but rather the logical asymmetry between such confirmations, right? Which require inductive inference versus falsification, which can be based on deductive inference. Okay, right? I'm sure you're all following along with this one. This simple opposition was later questioned by Lakatos. Now, that's how I say his name, and I do not give a crap about how you're supposed to say it, among others, right? Popper stressed that, regardless of the amount of confirming evidence, we can never be certain that a hypothesis is true without committing the fallacy of affirming the consequent, okay? And that's, what I'm saying here really is that I could go out there and say that I've gone around every apple tree in England and apples are green. Right? I've gone around every apple tree in England. Apples are green. I've tested it. The hypothesis is, are apples green? I've gone out there. I've tested every single apple, and they're green. Right? But in actual fact, we know that there's apples that are red. There's apples that are green and red. There's whatever. I mean, I don't even know if apples is a good example. It works for this example, but I don't know from a horticultural standpoint if maybe apples actually ripen throughout the colors. I'm not. Anyway, that's the digression again. But the point being that if you're saying something like the golden cross is going to happen, right? And when the golden cross happens, markets respond positively and they go up. I've looked back in time and I can see that in general, when I zoom out on the charts and I find all the golden crosses, that when I look at a golden cross, it seems that afterwards there's an upward trend, right? Fair enough, right? But Karl Popper would say to you, yeah, okay, right? Okay, you're saying that, but he wants to stress that regardless of the amount of confirming evidence and how many green apples that you find, we can never be certain that a hypothesis is true without committing the fallacy of affirming the consequent. Instead, Popper introduced the notion of corroboration as a measure for how well a theory or hypothesis has survived previous testing, but without implying that this is also a measure for the probability that is true. Okay, and Popper was also motivated by his doubts about the scientific studies of theorists like Marxist theory or the history of psychoanalysis, and so wanted to draw a line of demarcation between science and pseudoscience, right? And again, that's essentially what I'm doing in this episode, right? It's been a long-winded, chatty thing, but I want to draw a demarcation between technical analysis that I do, which is on every episode, which is witnessed a few days later down the line on all the other channels on YouTube and whatever else, and it's all talked about. And now I'm not blowing smoke up my own arse here, totally not. It's just that this is how my approach to it, and of course my approach, and I'm not, and I'm never always right either. And you know, I'd be very quick. I'd be in fact probably the first person to say that I could be wrong, because this is my approach here. You know, it's like I actually look to be wrong. I said this in an episode the other day before this occurred to me, and then it was kind of after saying that it reoccurred to me. Da Vinci's just published a video, Bitcoin 20k this year, and some other one. Go ahead, watch that video. Again, like I say, not a YouTube monogamist. I reckon my view time on this video will be like 10%, you know, whatever. If you've watched it through to this point here, then ching ching, pew pew, well done. Right, smash the like button. So yeah. So anyway, just because this is my approach, I would be the first person to tell you that technical analysis can absolutely go wrong. And in fact, you should look for it to go wrong. And when you're watching my videos, you should look for not necessarily what it is that actually confirms what you're already thinking, but the things inside my video which might go against what you're thinking, and the things that you actually disagree with what I say, because you're absolutely welcome to disagree with what I say, and I encourage you to do so. You know, and to then back that up with some reason for it or whatever. So yeah, anyway, pseudoscience. All right, Popper saw this as an importantly different distinction than demarcating science from metaphysics. The latter demarcation was a primary concern for many logical empiricists. Popper used the idea of falsification to draw a line instead between pseudo and proper science. Science was science because it subjected its theories to rigorous tests, which offered a high probability of failing and thus refuting the theory. The aim was not, in this way, to verify a theory, right? This could be done all too easily. The idea is that, you know, it's like you look at the charts. Let's bring the charts back up. Oh, shit. Excuse me. Dave messaged you, by the way, that from yesterday's video. That's why that says that on there. Let's just get Trading View back up. That was one of my best friends from school. Sent me a message during the start of the episode yesterday, and it made me smile. Shout out to Dave if you're watching today, by the way. I doubt it. How could you stick through this? Who can? What am I looking for here? Yeah, just generally speaking, the idea of like any of this sort of stuff. Like, let's zoom on. Let's go to this chart. Let's go to this chart here, right? And say, you know, for instance, we had a breakout of this symmetrical triangle, and there's a measured move to be had off the back of this symmetrical triangle. Does this fit? Yeah. So the scientific theory is that the prices are therefore going up into the 11,000s. You know, and it's so easy to try and find evidence that will point to that. So I could go back in time and find numerous other symmetrical triangles, draw measured moves on them, and say, oh, look how perfectly that actually worked out. I mean, for instance, is there one here that's handy to see? No, not on that chart. Is it this chart? Is it this chart? Is it this chart? Sorry, I do too many charts. Yeah, right here, for instance, there's a descending wedge here. It's the descending broadening wedge here. It had a measured move that played out on this one, and it came in pretty much exactly. Okay, so there's there's confirmation there for us that what we're talking about, for instance. And this can be done all too easily. It's dead easy. It only took me like a minute to do it there. 42 minutes in this video. Oh God, I'm still publishing it anyway. I'm gonna get messages from some people saying to me, "What are you doing, man?" Anyway, even in cases where observations were at first inconsistent with the deduced consequences of the theory, for example, by introducing auxiliary hypothesis designed explicitly to save the theory, the so-called ad hoc modifications. Now, this is what I was getting at again earlier on. You know, that it's very easy for me to say, like, this worked out here, and then go back over to here and say, well, you know, this is the measured move. But in various instances in the past, what we have done is come back down, retested the symmetrical triangle, and then gone on to make the full measured measured move thereafter, which is the ad hoc approach. First off, you start off by saying, you get a measured move from this, this is what's going to happen. It doesn't happen. Somebody says, why doesn't it happen? That disproves your theory. Then you say, no. Quite often there's this other additional thing, which is ad hoc, and it comes down and it retests this, and then it goes on up, and then it does the full thing. And that's called an ad hoc modification, okay? And this was what he saw done in pseudoscience, and a lot of technical analysis is pseudoscience, let's be honest, where the theories appeared to be able to explain anything that happened within the field to which they applied, see harmonics. In contrast, science is risky. Or fucking hell, or Elliott wave, right? Elliott wave theory. Elliott wave theory is the sentence fully 100%. In contrast, science is risky. Trading is risky. If observations showed the predictions from a theory to be absent, the theory would be refuted. Hence, scientific hypotheses must be falsifiable. Elliott wave theory. So not only must there exist some possible observation statement which could falsify the hypothesis or theory were it observed, Popper called these hypotheses potential falsifiers. It is crucial to the Popperian scientific method that such falsifications be sincerely attempted on a regular basis. Bang! Back over to the charts, going down to the 4-hour time frame, and pulling up this one, talking about how the other day we talked about shoulder, head, potential shoulder. If this were to break down below this level, you could get a measured move off the back of it, which would take you down to this area. Scientific theory. Actually, no, it wouldn't be. That's too big a measured move. It's more like that, down to here. And except, what were we looking for? We were looking for two things. One, confirmation of the scientific theory, of course, in the first instance. And then, of course, a significant proportion of the time, these things don't work out. What happens when they don't work out? Well, if you have volume coming in, you're breaking up above the head of the thingy, then maybe you've got a failed head and shoulders pattern. And maybe instead, you're going to have a rise up to the top of the rise and Y structure instead. And then there you go, it's a Popperian scientific method that such falsifications be sincerely attempted on a regular basis. Instead of just putting out videos which say Bitcoin to 20K this year, like Da Vinci, instead you go, I'm going to try and do this. So this is what we're all about here. I'm never going to make an episode like this ever again, and I'll probably never refer back to this one. This is just purely for the people who are going to get benefit from it. 45 minutes in, I can't really believe what I'm doing here myself, but I don't really particularly care. The more potential falsifiers of a hypothesis, the more falsifiable it would be, and therefore more hypothesis claimed. Okay, that's a difficult to understand sentence. That's that you don't normally see. You don't know. Okay, all articles like this are difficult to understand in general. Okay, fair enough, right? Whatever. That's whatever, right? Skipping on. Conversely, hypotheses without falsifiers claimed very little or nothing at all. Originally, very little or nothing at all. Okay, bear that in mind. Originally, Popper thought that this meant that the introduction of ad hoc hypotheses could only serve as a theory, should not be countenanced as good scientific method. These would undermine the falsifiability of a theory, right? Now, and the truth is really that as time goes by, coming up to the year of my birth, that obviously you evolve in your thinking, really, that you do introduce ad hoc type things from time to time. And the truth of the matter is that, we can come back down, retest an area and go back up. That's the truth of it. It really is. We can't just be myopic one way or the other. You can't just insist that you found a truth and that you're sticking to it no matter what, because that's in essence the exact same thing. But Karl Popper's own theory of falsification needed to have this built into. Essentially, it doesn't say this in this article, but this would be my university. Karl Popper needed to have this, and you can see this as a result of the evolution of his theory over time. He introduced a falsification aspect into his own falsification theory through the use of the ad hoc basis, which didn't actually undermine his theory, but instead increased it with a nuanced approach. And responding to surprising or apparently falsifying observations often generated important new scientific insights. So like that's the thing. It's like you can't just go around and say like all apples in England are green, and okay, great. So I falsified that theory. And now there are more types of apples. But maybe in fact actually it's not an apple at all, but it's a schnapple. And maybe you've got apples and schnapples. Like all oranges or all limes are green and taste exactly like lime. And then somebody found the yellow lime and it had a bit of a lemony flavor, and they were like, nope, there's lines come in two forms. You get yellow lines and you get green lines. And green lines taste like this, and yellow lines taste like, and there's plenty of things out there in the world that are actually kind of like that still at the minute, where people are like, yeah, you know, all chicken eggs are yellow, or are they white, or are they random? And funnily enough, UK farms throw out the white eggs. They throw them out. They throw them in the bloody bin, or they turn them into liquid egg mixture or powdered egg or whatever. In America, they throw out the brown eggs, right? In the UK, the most speckly brown eggs are like the most expensive ones. In America, you want pure white, whatever, right? Okay, now you could say, you know, like, you get it, right? So anyway, Popper's own example was the observed motion of your, okay, whatever, there's an example here at the end, right? And basically what it boils down to is that it blurs the distinction between falsifiable and non-falsifiable, instead speaking of degrees of testability, okay? And that's what we look for in terms of trading, and that's when the sort of the pseudoscience type elements come back in, and which makes that small square within the slightly smaller square totally viable and a good approach, and why I can absolutely still have respect for everybody out there who doesn't apply sort of generally speaking scientific method to their trading. Okay, it's why I also in my own videos don't, you know, go into extreme detail, but, you know, just wanted to kind of introduce an idea to you about all this. And then there's something down here as well that I wanted to think about. There was something else. Was it here? Just on Fisher's view, hypothesis testing was a methodology for when to accept or reject a statistical hypothesis, namely that a hypothesis should be rejected by evidence if this evidence would be unlikely relative to other possible outcomes, given the hypothesis were true. In contrast, on Neyman and Pearson's view, the consequence of error also had to play a role when deciding between hypotheses, introducing the distinction between the error of rejecting a true hypothesis, type 1 error, and accepting a false hypothesis, type 2 error. They argued that it depends on the consequences of the error to decide whether it is more important to avoid rejecting a true hypothesis or accepting a false one. Hence, Fisher aimed for a theory of inductive inference that enabled a numerical expression of confidence in a hypothesis. To him, the important point was the search for truth, not utility, right? In contrast, Neyman Pearson's approach was provided a strategy of inductive behavior for deciding between different courses of action. Here, the important point was not whether a hypothesis was true, but whether one should act as if it was. Okay, so, right, not going to go into great detail explaining all of that. I'm sure most of you understood what I'm talking about there, and that is exactly how you can apply all of this to trading. Of course, we're really actually looking for utility. To us, we're not scientists here, and we're not trying to prove the existence of life on Mars or not. We're actually just looking for the utility and whether or not we should act as if something is true, even though quite often in the face of things we can see that it isn't, and or, you know, it isn't like true or whatever, and that we can apply that to our own trading. Okay, now, right, the most unusual technical analysis video for trading that you will have ever seen. This is not what you will be taught in any technical analysis course. It'll never be on any investment management course at university. It'll never be in any course that you get sent to if you go and work at an investment bank and you say you're a junior investment manager, for instance. They're not going to send you off on this. This information here is unique to the Rocky Outcrop channel, okay? This is just me providing some information for you from the world, which is standing on the shoulders of giants. We're going back hundreds of years. In fact, you know, actually this whole thing goes back thousands of years, really. And all of these things come together to help give you a more nuanced approach to your trading. And if you actually then bear all this in mind, with the Dunning-Kruger effect, essentially, or whatever, where you know, with the bit that I showed from the video yesterday, not the overall effect, you know, not the stupid people think that they've got more confidence, which is what that effect is, but the other part of it, which is that as your knowledge about a subject grows, your confidence can kind of actually sometimes decrease relative to that. And just to bear in mind that that's okay, right? And what you're actually going through here, what you're actually doing as a process of that, it's 52 minutes long. It's far too long, this video. I can't believe, if anybody stays to watch the whole thing, by the way, let me know. Put the word write Geronimo or something like that in the comments down below. Then I'll know you watched the whole thing. No, will I? Well, you could have skipped. I don't know. Whatever. The point here is that this scientific method idea is taken hundreds upon hundreds of years. Like you're looking at the references here, 1955. This was from 2000, 2002. This is back when I was doing uni. In fact, I wonder if this article's from back when there, if it's got anything from post-uni time. Oh, it does. I'd already graduated by that point, 2008. So, you know, it's still ongoing. You've got 2003, 1999, 1995, 1993. That book that I just, the Karl Popper's thing where he kind of introduced the extra idea about Uranus. Bearing in mind that it was only in 1985. In fact, it was only in the year 2000 that we actually proved. I think it was the year 2000, maybe 2002 or something, that we actually proved that the dinosaurs were wiped out by a meteor strike. Until then, it was just a theory that had, that was it was falsifiable, and there was a lot of debate about it in the field. And until that time that they discovered X, Y, and Z, it was hotly debated, right? I'm pretty sure every single person watching this grew up knowing that the dinosaurs were wiped out by a meteor strike. Well, the science for that only came around at the same time as sort of Y2K bug. This is an evolving thing. This will always be the case. For the rest of the time, it will always be the case. And the same idea here is that that as you learn to become a better trader, and if you were to go back in 1910, you could have read a book called How We Think. And then you could have gone back even further to the Grammar of Science back in 1892. And then you can come all the way up to 2009 and find another book about the different levels of scientific education. And you can talk about Popperian falsification. You can talk about X, Y, and Z. None of it really matters. All of it really, what really matters here is that you're open to the idea about the evolution of knowledge and your own part to play in that, and that you will actually that the confidence that you should have shouldn't really diminish as you increase. But it does, because you don't have somebody out there saying to you, you're on the way, you're doing the right thing. This episode here is for everybody out there who has at some point experienced a dip in confidence, having increased their knowledge about a particular field. And I just wanted to throw all this out there and say, look, there is this counterbalance to things. There is the scientific method, and this has gone back for thousands of years. We're talking like Socrates and all sorts of stuff, like way thousands of years ago, like 1,000 years before the birth of Christ. This is a conversation which will never end. And the approach to trading is somewhat in between the science and the pseudoscience aspects of it. And the thing that's going to do for today. Honestly, my videos are actually technical analysis. Check out any previous video and you'll see me looking at the charts. I just wanted to say, I just wanted to do all of this with you for today. It's been great. Thanks very much for sticking through for this hour-long lecture. 55 minutes, 50 seconds, 52, 53, and then you stick the starting in thing there. So it's going to be 57-minute long video on YouTube or something like that, 56, 50. I apologize for it, right? Okay. Yes, it's been enjoyable for some of you, for this very, very small fraction of people. Let me know if you watch the whole thing. And then to everybody else, I apologize. But of course, that apology is going out there into the vacuum. It's far too late for that. They detuned, hit the thumbs down, unsubscribed ages ago. Please do share these videos with a friend if you got one you think you'd like it. Not because of this video today at all, but because this is how we look at things in general, and this is my stance on trading. And we actually look to try and falsify things, and try and adopt the Popperian method into your own trading, and it might increase your sort of your willingness to let go of a bad position. And really, to be honest with you, that's risk management is 90% of trading. Thanks so much. Catch you next time.